Today, we're going to peel back a layer of the Nifty 50 that most people never see. We're not talking about conventional technicals or fundamentals. Instead, we're diving deep into the market's hidden architecture, a world of powerful, almost invisible hedging flows that, as we'll see, really dictate short-term price action. Our focus will be on the quantitative framework you need to actually model these forces.
So, here's our roadmap. We'll start with this idea of an unseen market architecture, then get into the physics of how dealer positioning works. After that, we'll get technical and construct the gamma density model itself. From there, it's about translating that into a systematic strategy, looking at its actual performance, and finally, wrapping up with what it all means for the current regime, its risks, and our conclusion.
All right, let's dive right in. The entire premise of this analysis rests on one core idea. Short-term market behavior isn't just random noise. In fact, a lot of it is a direct and, more importantly, a measurable consequence of structural positioning within the market. And that brings us to a really central question. In today's market, with all the high-frequency trading and complex derivatives flying around, what is the invisible force that so often seems to dictate these clear, almost predictable intraday support and resistance levels in a major index like the Nifty 50?
Well, the answer, as it turns out, isn't usually found in typical chart patterns or the day's macro news. It's actually hidden deep within the market's plumbing. And we're talking about the aggregated gamma exposure of options market makers. You see, these dealers have to constantly hedge their books, and that very act of hedging creates these incredibly powerful reflexive flows back into the underlying index itself.
So, to really grasp this, we need to dig into what I call the physics of dealer positioning. This is all about the mechanics, how activity in the options market translates, step by step, into real buying and selling pressure in the spot market.
And the key concept here is something called gamma exposure, or GX. Now, the formal definition is that it's the rate of change of an option's delta, but for our purposes, it's much more useful to think of GX as the acceleration of a dealer's exposure. It tells us how much their hedge needs to change for every single point the Nifty 50 moves. And this is what really drives the feedback loops we're about to unpack.
This brings us to the feedback loop, and this is really the crucial part. It works like this. A customer buys options, let's say calls. The dealer takes the other side of that trade, which usually makes them short gamma. Now, to manage their risk and stay delta neutral, they are forced to hedge by trading the underlying index. And the key here is that these hedging flows aren't a choice. They're systematic, they're often automated, and it's the sheer volume of these flows that directly impacts the index's price. Okay, so this hedging dynamic creates two very distinct market regimes. First, you have a positive gamma environment. Here, dealers are long gamma, and they end up selling into rallies and buying into dips. They basically act as a stabilizing force, which dampens volatility and encourages the market to mean revert. But in a negative gamma regime, it's the complete opposite. They're forced to buy into rallies and sell into dips. This amplifies volatility and really fuels momentum. And as you can imagine, knowing which one of these regimes we're in is absolutely critical. Okay, so that brings us to the real core of this work. How do we actually measure and visualize this hidden structure? And the answer is, we have to construct what's called a gamma density model. Now, building this model is, frankly, a non-trivial task. You start by calculating the gamma for every single strike price. But that's not enough. You have to weight it by open interest, because that's what tells you where the risk is actually concentrated. Then, you have to make these really critical adjustments for time to expiry, since we know gamma decays exponentially as an option gets closer to expiring. It's only after you aggregate all of this adjusted data across the entire Nifty 50 options chain that you start to get a true map of potential hedging pressure.
And this is the output, the gamma density curve. You can think of this as our quantitative lens. What it does is it visualizes the total amount of gamma sitting at each strike price. This lets us see exactly where the biggest pockets of dealer exposure are, and by extension, where their hedging flows are likely to be the most intense.
And when you look at this curve, one feature often stands out above all others, the gamma wall. This is simply the strike price that has the highest concentration of positive gamma. And what it does is it acts like a powerful price magnet, almost like a gravitational well for the index. As the price gets closer to this level, the dealer hedging, that buying of dips and selling of rallies, becomes so intense that it can often just pin the price right there.
So the next logical question is, how do we translate all this theory into a testable rules-based framework? This is where we shift from observation to actually formulating a systematic strategy.
The logic for the strategy is grounded entirely in those hedging mechanics we talked about. The idea is, as the price comes down and nears a gamma wall from above, we'd initiate a long position. Why? Because we're anticipating the dealer buying pressure to kick in.
Then, as the price moves away from the wall and that hedging pressure subsides, we reduce or exit the position. But the most important rule is this: if the market's overall gamma ever flips negative, the strategy is suspended. It just turns off. Because in that kind of regime, dealer hedging is amplifying moves, not dampening them. So our whole mean reversion rationale becomes invalid.
Of course, any systematic strategy is worthless without robust risk management. For us, that's non-negotiable. The framework has predefined stop losses and, as I mentioned, that critical gamma regime filter. We also use volatility-targeted position sizing, which helps keep our risk contribution constant no matter what the market is doing. And finally, we build in assumptions for execution based on liquidity analysis to make it more realistic.
All right, let's turn to the empirical evidence. What we're going to do now is a sober analysis of the historical backtest results. And the key here is to focus not just on the returns, but also on the risk profile and, just as importantly, the periods where it underperformed.
So if we look at a comparison of the maximum drawdown versus a simple buy and hold on the Nifty 50, you can see the risk profile is, well, it's notably different, and that's really by design. Those regime filters we talked about are specifically there to try and sidestep the deep, protracted drawdowns that you often see in passive indexing, especially during those negative gamma environments.
Now, looking at the rolling one-year Sharpe ratio gives us a sense of the risk-adjusted returns over time. A single number can be a bit misleading, but looking at it this way on a rolling basis helps us see the periods when this mean reversion edge, driven by the gamma structure, was at its strongest and when it was weaker.
But it's absolutely essential to understand the failure conditions here. This model is not a silver bullet. It's most vulnerable in basically two scenarios. The first is during really abrupt structural regime changes, when market positioning just shifts on a dime. And the second is during those persistent, low-volatility trending markets where any mean-reverting impulse just gets slowly ground down by a steady directional drift.
Okay, that brings us to our final section, where we'll apply this framework to the current market, talk through the model's primary risks, and then offer some concluding thoughts.
So with this entire framework in hand, the natural question is, how should we interpret the current gamma regime for the Nifty 50? And let me be clear, this is about using the data to understand the market's structure, not about trying to predict its next move. Based on our model, the current gamma distribution suggests that the market is in a relatively contained, positive gamma state. What that means is there's a significant amount of liquidity being supplied by dealer hedging around key strike levels. This kind of structure implies that volatility could remain somewhat dampened, and that sharp directional moves might be limited because these hedging flows are acting like buffers. Of course, this is a very dynamic situation, and it's something that requires constant monitoring.
And we have to wrap up with a very clear-eyed look at the risks. Look, a model like this is entirely dependent on the quality and accuracy of its options data. It can also be fragile during sudden market structure changes. Think of a flash crash scenario. On top of that, the liquidity assumptions we make can break down during major stress events. And of course, real-world execution always has slippage and transaction costs that a backtest can never perfectly capture.
So, if there's one key takeaway from all of this, it's this. To really understand how markets behave today, we have to expand our view. It's no longer enough to just map human sentiment or look at economic forecasts. We also have to be able to map these systematic automated hedging flows, because they now form the invisible and often the dominant architecture of the market itself.